Hello and welcome to Switzer Investing Insights, brought to you by NAB Trade. I'm Peter Switzer, and we're going to be looking at reporting season again, and we're going to go for the big companies that have been the stars of reporting season so far. Paul, let's kick off with Wesfarmers.
Yeah, of course, one of Australia's biggest retailers. Earnings down 3.3% to $2.35 billion, and NPAT down 2.7% to $1.54 billion, Peter. That excluded impairments of about $1.3 billion. That's largely the write-down,
wasn't it?
of Bunnings UK, which they purchased less than 2 years ago. Also some intangibles on the Target brand. Cash generation was strong despite all that. Net debt fell to $3.9 billion. And that was also while they increased net capital expenditure. And for shareholders, an unchanged dividend of $1.03.
Well, Paul, Wesfarmers is the country's biggest conglomerate. There's a lot of moving parts. Let's go through and look at the divisional earnings.
Yeah, so on this page, we've got the divisional earnings and the change from the first half of 18 versus the first half of 17. The star of the result, of course, Bunnings Australia. This is the first time it's actually topped the Wesfarmers League chart. So it actually contributed more than the Coles supermarket division, which was down 14.1% to $790 million. Look, other big contributors were, of course, Kmart. That's part of the department stores and Officeworks. The resources business also had an improvement in earnings, largely due to higher coal prices.
Okay, so let's go look at the positives and the negatives.
Well, look, I mentioned Bunnings. Kmart, Officework and resources were all big contributors. The balance sheet, strong cash flow generation, as I said, that allowed net debt to come down and also capital expenditure to increase. And really, I think the thing that took the market size was the sales momentum in Coles. Now, Coles has been struggling because of the supermarket wars, and that's why earnings were down. Yeah. But actually, they had a first sort of positive increase in sales. So they look at sales on a comparable stores basis every quarter. In the second quarter, comparable store sales are up by 1.3%. Not a big increase.
No. So it could be a turning point.
Still likely to be smashed by Woolworths when it reports, but at least it's on the right sign, and that was accompanied by transaction growth and also basket growth, or the number of things in each basket. So that was a positive. Negatives, obviously, the whole disaster of the Bunnings
Unbelievable,
in the UK. Look, what Bunnings is going to do with that business, we're not sure, but that's going to continue to lose money. I mentioned competitive pressures in the supermarket business. Obviously, that's not going to go away either because of the price wars going on between Woolworths and Coles and Aldi and others. Target's still a problem child, so it had negative sales of down 6.5% in the second quarter. And the outlook for industrials, which is the other part of the conglomerate, is also a bit mixed.
Okay, Paul, let's go to the big Australian, BHP.
Yeah, it's reported attributable profit $4.1 billion. That was up 14%. Now again, we had some write-offs there to do with the US tax changes, so the actual reported NPAT was only $2 billion.
So Donald Trump's tax changes weren't good for BHP in the short term?
Not in the short term, and that's because they've got a lot of deferred tax assets, and you've got to bring them back on your books at a lower tax rate. They're not worth as much in the long term. Yeah. Underlying EBITDA of $11.2 billion, up 25%. Good on the free cash flow of $4.9 billion. And for shareholders, a dividend of 55 US cents per share. That's the interim dividend. That was up 38% from the 40 cents in the corresponding half in 2017.
Well, Paul, I'm prepared to forgive BHP after that big dividend cut in the past.
Yes, they got over the so-called progressive dividend, and we're starting to see the benefits of that. Look, moving on to the positives and negatives, Peter, big increase from the copper division. And copper, the price for copper has really been booming, so that's been a big contributor. Balance sheet strength, net debt down almost $1 billion to $15.4 billion, gearing at 19%. Look, they say they're thriving, that's their words, on lower levels of CapEx, and CapEx is a lot less today than it was 5 years ago. Return on capital employed, so that's ultimately the return on from a shareholder's point of view, up to 12.8%. They are going to progress the exit of the US onshore oil and shale business, which I think was inevitable. And they've set a US $2 billion productivity target for FY18 and 19. Yep. The negatives, well, the profit was below the analysts' expectations. It was around about $4.25 billion. They delivered $4.1 billion, so it was a bit of a miss there. They talked about negative productivity. In other words, their costs went up, and something like around about $500 million US, largely from a lot of the work going on Olympic Dam and the Olympic Dam shutdown.
And the sector is getting better, so costs go up with that, don't they?
Yeah, but all of the major resource companies have been working hard on their costs, and we've come to expect actually improvement through productivity, and BHP had a productivity miss in their own words. And the iron ore cost, look, there was a marginal improvement to US $14.90, but perhaps not as much as the analysts were looking for.
Okay, Paul, let's go to the upstart rival in the West, Fortescue.
Yeah, Fortescue was a different story, and all the numbers here are down, and I'll come to that in a moment. So let's just deal with the headlines. Revenue down 18% to $3.7 billion. EBIT down 31%, NPAT down 44% to $681 million. Gross debt, that's probably a positive, down to $4.2 billion.
Which is extraordinary for them because it was much bigger, wasn't it?
It was huge at one stage, and the interim dividend, representing only a payout ratio of 40%, down, this is in Australian dollars, down from 20 cents a share to 11 cents a share.
That will annoy a few people.
Well, it will annoy a few people, and let's go to the story of why the dividend is down and all the numbers are down. And this chart on the screen in front of you tries to explain, as Fortescue sees it, the challenges in the iron ore market. Now, when people talk about iron ore benchmark pricing, they talk about so-called 62% iron ore. Fortescue,
Top notch.
Top notch. And Fortescue produces a lower quality iron ore that gets mixed.
Lower notch.
Lower notch. And what, of course, what has been happening in the last year or so is a lot of work by the Chinese government, where they've been looking at the steel mills. As part of the effort to sort of improve productivity, reduce pollution, the margin between the top-notch iron ore and the lower-notch iron ore has actually widened. So if you actually look at this chart, it shows you that the actual margin that Fortescue earned in the first half was down to US $24 US per tonne, but compared to $33 US in the first half of 2017. So Fortescue's really suffered from this sort of widening of the gap between the top-notch iron ore and the lower-notch iron ore, corresponding lower revenue, lower EBITDA, and lower NPAT.
Well, I guess it's a nice start to the new CEO.
Yeah, so let's go to the positives. Look, they are the lowest cost producer, and they did actually reduce their costs further down to $12.11 per tonne. You were talking about BHP earlier. And they're guiding to under $12 in the second half. They did ship what they said they're going to ship, and they've maintained their guidance of 170 million tonnes to be shipped. They actually expect the full year price realisation to be closer to 70 to 75%, so they're actually forecasting that margin to improve in the second half.
Okay.
And a dividend ratio to pay out to return to somewhere between their target of 50% to 80%. And they have some development options for the Eliwana and Iron Bridge. The Eliwana is part of their strategy to actually improve up the quality of the iron ore they produce. Negatives, I mentioned the iron ore, the price is realised. There's obviously risk that continues, Peter, so Fortescue's confident it's going to close a bit. The market, there's some risk that doesn't happen. And then just the other negative, that dividend of 11 cents was less than people were expecting, and so one of the reasons why the immediate reaction to the share price was to mark it down.
Okay, look across those three companies, Paul. What's the overall feeling from you?
Well, look, they're all okay. I don't think there's... Wesfarmers was just a little better than expected. BHP and Fortescue were a little worse than expected. So, look, nothing to stand out, but again, nothing to really wrap your socks in and say this has been a stellar
And would you
result.
dump any of those stocks because of what you saw?
I think Wesfarmers stuck in a trading range, buy under $40, sell on the mid-40s, $45.
Yep.
It's been that way now for almost a couple of years. I think BHP and Fortescue in weakness are still buys because I think that the upside on commodity prices is still reasonably strong.
I don't always say this, Paul, but I totally agree with you. So that's Switzer Investing Insights brought to you by NAB Trade. Thanks for joining us.